Welcome to this webinar on risk management in times of high volatility and inflation. My name is Marielle Barkley, and I'm the editor of this award-winning Global Treasury Leaders Program, which is organized by The Economist Impact and is sponsored by Deutsche Bank. The program's objective is to share thought leadership and to connect treasurers around the world. And we do this through a series of activities every year, which include summits in different regions. I'm working on the New York one coming up in April, webinars like this one you're joining today, and an online community where we host these webinars. The community is open to corporates only. And this allows treasurers from all over the world to connect and exchange ideas on any topic of their interest. It is totally free, and I'm going to now send you a link via the chat facility so that you can join if you would like to. Just remember to choose the Global Treasury Leaders Network when asked what groups you would like to join. There are many, and you're free to join as many as you like, but if you want to connect with us, it is Global Treasury Leaders Network. Going back to today's webinar, we would like it to be as interactive as possible. So please ask as many questions as you'd like using the questions tab on the right-hand side of your screen. And please send them to us as soon as you think of them. Otherwise you will forget. We will bring them up when appropriate. So without further ado, please let me introduce this webinar's chair, Lisa Dukes, former corporate finance director and treasurer at Drax, and co-founder of Dukes and King. With that, Lisa will now introduce our speakers. Lisa, over to you.
Thank you, Marielle. Firstly, let me welcome you to the session on risk management in times of high volatility and inflation. So over the last decade or more, we've had various different challenges, shall we say, to manage. We've experienced volatility usually only seen in emerging markets more recently, with high volatility taking no prisoners across currencies, commodities, or rates. Even the ironically named stablecoin was, well, less than stable. Recently, a black swan event has felt more like a white sheep event, with the energy crisis, Russia-Ukraine war, post-COVID monetary policy, and global recession, to name just a few, and all on the tails of COVID and Brexit. With such extreme moves and market dynamics, companies have been considering how to manage both the risks, but also the opportunities arising from their exposure to these markets, as well as the macro economy generally. This includes the knock-on effect to cost of capital, as well as capital allocation. Many have taken a chance to review existing policies and ensure that they're fit for purpose, both reactively but also proactively, not just for the current environment, but also looking to the future. I'm delighted to have Todd and Yang here with me today to share their perspectives on the topic. Now, before I hand over them to introduce themselves, I will just remind you again that we will be taking questions throughout the session, so please don't wait to the end and submit your questions as they come to you. So Yang, can you kick us off by introducing yourself, your company, and how your team is structured?
Yes, sure. Thanks, Lisa. My name is Yang Xu. I work for Kraft Heinz company. So hopefully many of you are our consumers. Famous Heinz ketchup and Kraft single, so on and so forth. So my company is a 26 billion of revenue company, present in over 130 countries. And then we have a debt outstanding about 20 billion as we speak. My role is a global treasurer and also head of the corporate development. I have offices set up in Chicago, that's our headquarters, but also in a couple of places across Europe and Asia Pacific. Very glad to be here.
Perfect. Thanks, Yang. Todd, could I ask you to do the same?
Yes, absolutely. So thank you for the invitation. It's always an honor to get a call from The Economist, and so happy to be here. I work for Fluor Corporation, which many people don't know what Fluor is, but it's a large engineering, procurement, construction company. So Fluor builds some of the largest, most complex, capital-intensive projects around the world. So we do business, very large global footprint, and key on safety. And so we're one of the safest EPC businesses in the world and have a history of over 100 years in business. So it's Fluor Corporation. My role at Fluor has evolved over the past 12 years, but most recently I'm Global Managing Director of Strategic Finance and Treasury for the organization. And also just quickly to say, it's an honor to be here. Lisa, I understand you have an extremely successful consulting business that you founded in the treasury space. And Yang, I've known in two dimensions and messages for many years, but I was able to meet Yang last year in New York in three dimensions for a couple-day session with The Economist. And she is one of the most amazing treasurers in the world, and an amazing person, as well as an amazing treasurer. So I'm a huge fan. So it's an honor to be here. Thanks.
Likewise, Todd. Now, as we've already covered, there are, or they have been, and actually still remain, a lot of factors that are impacting markets. Each are complex in their own right, and each will impact companies differently. Could each of you share your thoughts on what you're observing in the markets, as well as what you see as the key areas impacting treasurers at the moment? Yang, can I come to you first?
Yeah, in the most recent period of time, we have obviously observed the high inflationary area. Why that's important for us is obviously we are in a food company, and raw materials are very important for us, such as wheat, such as oil, so on and so forth. So the war, very unfortunate war between Russia and Ukraine did push the inflation to a new high. But beyond that, all the energies and impacting everyone in all sectors, impacting the energy on a day-to-day basis, but also packaging. So I think many sectors are being impacted, among which our company. Beyond that, when you look at the market, of course, comes along with a high volatility, and there's a flight to safety. So there's a meaningful depreciation against the dollar, so for many emerging currencies. And the risk environment also, because of the tightening, or how do I say, because of the coming to an end of the quantitative easing in many markets, so the risk has been on the rise, and we also see meaningful inversion. That begs the question about what's coming next. So the recessionary scenarios, and when, if it's going to happen, or how deep it's going to happen. Those kind of scenario planning, I think, is not only on my company, but many company treasurers is on the front center of their agendas.
Thanks, Yang. Todd, would you like to go next?
Yeah, I would just echo a lot of what Yang said. It looks like we're thinking about a lot of the same things. So, you know, from a market perspective, I think we've seen more tail risks materialize in the markets than ever before, at least in my 20-year career in the business. And so it's almost like tail risks we've just become more used to seeing them and experiencing them. And so to echo Yang, you know, modeling those tail risks, I think is an area that treasurers can add an extreme amount of value. You know, I like to say, you know, treasurers that can see around corners, which is impossible without a mirror. But there's a lot of proactive things you can do to be able to anticipate and just really be proactive. So, you know, I don't have to tell our listeners, you know, all treasurers, treasury related, chief financial officers, if you pick up any paper, right, it's the volatility in currency, interest rates is huge, right? Commodity prices, even shipping costs, logistics, and Yang mentioned packaging, right? And then what I've noticed is inflation, right? And I don't know how many times you can count the words that earnings calls in recent times have mentioned inflation. And inflation, we know as treasurers, really dissecting risks, financial risks to the business, inflation can really encompass a lot of different things, right? And some of those things can be hedged. So I think it's important we all remember inflation we shouldn't view it as a free pass. Like, well, that's inflation, it's headwinds, it's tailwinds, it's out of our control. A lot of that is really in our control, and there's things we can do about it. There are a lot that's out of our control, but and then energy is critical, and hopefully we can talk more about energy on our call today. But that impacts everyone in a very serious way. So 2022, the VIX had more days over 20 than we've seen since the global financial crisis. So that tells you volatility is here. Inflation, 2019, we went into 2019 with, average for the year 1.8, 2020, 1.2, and then we go into 2021 and see 4.7 print. And now 2022, we started seeing, very large prints with an average around 8. So inflation is definitely a concern. And when we look at inflation, right, not non-core inflation is really what we as individuals see and impact our lives more frequently. Energy costs, food costs, and it hurts. A lot of times, it hurts those that can least afford to deal with non-core inflation. Mm-hmm. And then we have the Federal Reserve with their mandates being, to core inflation. That's what they feel is in their remit of things that they can influence. And so inflation and employment. And so those are the two focuses. And, I wouldn't want the job. I wouldn't want Mr. Powell's job, Dr. Powell's job. But I seem to be in the camp of, it's a perfect storm for inflation, given, the unprecedented times that we've been living in the last few years with lockups, no production, just a halt to everything, shipping, nothing shipping. And then you pour on pandemic relief fund cash, which I think is absolutely necessary, to protect our fellow humans, I think is extremely important. And then we saw high demand for goods, right? When everyone's locked up and they do have some funds to live on, and there is no services spending because it's just not an option. So as Milton Friedman said, inflation is anywhere and everywhere a monetary phenomena. And I tend to agree with that. So with that, I don't know how much inflation is really, transitory was used early on. And then they really received a lot of backlash for it's not transitory. I'm in the camp, I think some is transitory, and I also think some is not transitory. All inflation isn't created the same. So we saw a lot of data that came out in 4Q of 2020 that says, at least in, the U.S. Americas markets, spending is down tremendously. And so there's fears of that. And then we have Triffin's dilemma, right? Which I think plays a part in all of this. And with Triffin's dilemma, just for our younger treasurers, the United States has the global reserve currency, the hegemony status, which many say is a great privilege. Sometimes I think it can be a great curse. But so the challenge for our Federal Reserve is to balance what is good for the United States economy with their actions, but as the global reserve currency, what might those impacts be to emerging markets and developing countries around the world? Since there's so many transactions outside of the U.S. that are denominated in U.S. dollars. So Triffin's dilemma, I think, is a word that we're going to use a lot, and most of us haven't used it since, in graduate school when we studied economics. But I think it's going to be a word we use a lot more. And then we're seeing, the 2s and 10s spread. So we're seeing a lot of yield curve inversion. The 2s-10 spread, the high was, I looked back and saw 2011 was the high at 291 basis points. And the low actually was 1980 with a negative 241 on the 2s-10 spread. And so right now we're and the 2-cent spread for our younger treasurers, again, historically from 1955 to 2018, give or take, has successfulally predicted recession when we see that yield curve inversion. Generally has been a 6 to 24 months before the recession actually hits. So
sorry, Todd, just to maybe move to Yang, just to see if all of those factors are feeding into the capital market. Practically, are you seeing those instances and all the yield information there feed through to actually how you access the capital market? Maybe come to Yang and then we can come back to Todd.
Certainly happy to share. So it was a couple of years ago. Well, let me take a step back about my debt capital market management philosophy. I think for all treasurers, liquidity always through cycles needs to be front centered. Actually, that comes with the job. So we carry this fiduciary responsibility of always minding a company's liquidity. So a couple of years back, when we look at the company debt portfolio, when we look at what potential impact could be during the pandemic and so on and so forth, we as a company, we restructured many of our debt towers. In particular, pre-pandemic and even sometimes during pandemic, we have knocked out many of the near-term tall towers through a series of either pure liability management or through a tender refi, so that we really can stack our debt for the longer tenor. And we purposefully chose, at that time we took a point of view, we purposely choose much more fixed rate debt. So right now, if you look at my debt portfolio as example, it's much longer. It's 10 years out, the tenor, and over 90% is fixed. Because we, as Todd was early on saying, that we need to see around the corner. So this is number one. Number two, what does it do is lead to the number two is then therefore my liquidity needs is much reduced in the near term. That creates a lot of flexibility in terms of if you need to go to the market and how you go to the market. Do you have to, or you can opportunistically tap in the market, right? So right now, because of the inversion, the rates on the rise, I have observed many treasurers, they say, well, going for tenor, because when you look at a 3-year versus a 10-year debt, as an example, you would say, well, actually you pay 5 basis points, actually you can get duration, why not? But certain treasurers also thinking that maybe I will have liquidity, or maybe the near term, the rates is coming down, therefore we have a barbell strategy, therefore I couple the near front end and the long end. I think that was all right strategy, but right strategy has to be driven by the company's liquidity needs, and again, coming back, liquidity scenario planning, I think, is the most important, and that should drive if we go to the market and how we go to the market.
Perfect. Todd, is that in line with what you're seeing practically?
Yes, absolutely. That, yeah, right on. very valid points, and it's not an a science. It's an art, right? And that's where I think, and especially with the current environment that we're living in, and the attention that it's getting from the board of directors, from shareholders of many different companies around the world. Now is the time for Treasury to really shine and show that proactiveness and make decisions and good communication. Bring the team along so that you're not taking a personal view as a treasurer on should you be in the market now? As the 10-year has come in some, is now the time to go, or is now the time to recast or to do some swaps or look at synthetic debt issuances and other currencies? So yeah, I would completely agree with Yang.
So maybe if we think of some of the softer side now, as treasurers lead and adapt to many of the changes you've just described there, so we've covered a lot already with inflation, interest rates, to name a few. It could impact the treasury skill set that's required and perhaps how the team needs to be structured going forward. Perhaps you could both share some changes that maybe you've made or would want to make, or perhaps just the evolution you're seeing in the market. Should we start with you, Yang?
So Lisa, oftentimes when I talk with my team, I often layer our responsibilities into a reverse pyramid. And let me articulate a little bit about the reverse pyramid. My first layer of the pyramid is really the control and compliance. I think, of course, because we do a lot of derivatives and we move money around the world, we talk about billions at a time. So it's really paramount, and no news is good news. Like, has to be very solid and bulletproof. So that is a number one layer. I don't think it will change. And heightened volatility just to need heightened view of just to make sure the foundation is rock solid. So the first layer. Second layer for me is processes. I think that is also making sure that we adopt the technologies and the automations and systems so that make our life, number one, easier, make sure that we can see liquidity, and make sure when we have exposure collection and so on and so forth. So the process really is clean, is smooth, and you can trust. And so on this front, I think with heightened volatility, it really requires much more visibility. And a very simple example is I need to see where the cash is on a daily basis. So right now with my TMS, I have over 90% of my cash balance. It's not 100%, but over 90%. I know on an instant basis where my cash is, so I can make real-time decision in terms of, do I sweep liquidity to the places where they need, or do I need to hedge certain currencies because that's out of necessity? So that is quite important, the second layer as processes. And the third layer for me is major transactions. So early on, Lisa, you talk about debt capital market. It's the same thing. Sometimes when you look at the window opportunity for us to tap into the in-the-money monetization of certain swaps and so on and so forth. So those major transactions, and sometimes we even looking into pension and insurance because they roll under my global treasury. But those places is where once you can protect the risk for the company, then you can take a step back to say, how do we create values when I tap into the window of opportunity? So those are things needs to be my treasury professional to be extremely agile and to be in sync with what the market is going. So really seize those opportunities. And the last one is the tip of the pyramid. I call it the value creation strategic advisory. Those are the constant dialogue with the management team. Those are the constant dialogues with the board of directors and with the banking partners, with the investors, with the credit rating agencies, and so on and so forth, to make sure that you have the capital allocation that is in sync where the economic cycle is, and in sync with your business is heading to. And I think I call it reverse pyramid, and it's because you cannot move on to the top of the pyramid without having your foundation extremely strong. So for me, is layer by layer. I don't think those layers would change through cycle, but I think during a volatile time such as what we're experiencing now, It's just to make it even more heightened and even need more agility and externally connected treasury team.
Todd, have you had to access more resource, different resource, more expertise?
Yeah, no, I would echo again completely what Yang said. I guess so to kind of audible here and shift to different aspects of the question. Leadership. I think in the times that we're living in right now with so much uncertainty in the financial markets, and is there a soft landing? Is there a recession coming? What will happen from a geopolitical perspective, and how might that impact our business? I think from skills and retraining and reprioritization, leadership now is more important than ever before. So leadership with excellence and confidence and humility. And those are the type of leaders who understand the benefit of DE&I. And DE&I is something that if a business wants to succeed and be successful, as we see all of this acceleration and change in technologies in the business and in the financial markets, DE&I, that's how you're going to adapt and survive or become irrelevant. That's my personal opinion. Having diverse thought, diverse backgrounds, diverse experiences, and being a leader to make the culture comfortable enough that you're not only building these diverse teams, but you're encouraging them, and they feel the comfort and the trust to be able to share and contribute to the team. The power of that is, and I'm learning more and more, over the past 5 years, just how valuable that is to the organization. So instead of, the typical, we need to reskill, we need to upskill, all that's true. It should be strategic on who and how and where you plan to do that to get not only to engage the maximum benefit from each individual employee and their goals and dreams and their talent areas. But, I've been saying for many years, technology is something that treasurers on the team, they have to have. It's not like optional.
No, I agree. Mm-hmm.
Yeah.
Should we take the opportunity to move on to one of the recent market disruptors, the volatility in energy prices? Now, not only did energy prices go up very rapidly, they've also come down very rapidly, with natural gas in Europe down over 70% since its peak, which has no doubt put additional pressures either on managing commercially or in deciding how to approach hedging and managing more generally. Todd, you've already mentioned the energy kind of crisis. On that topic, are you experiencing those financial impacts, and how are you thinking that they will impact the business moving forward?
Yeah, no, I think everyone is globally to some extent, some more and some less. And energy is something that I am extremely passionate about. I'm also passionate about food insecurity. So being involved with one of the largest food banks in Dallas, Fort Worth area. Food insecurity is one of those things that's important to me, that I'm passionate about. Energy security is quickly becoming a major part of that, because as we talk about in Yang's triangle, I'm going to steal her triangle idea because I love that. But if we flip that back to when we were in university, right, we studied Maslow's hierarchy of needs. I had a conversation in New York. I was speaking at one of the bank events in New York, And, you know, I was talking about energy is really critical, and it's number one. And this person mentioned water. And so my response was, well, how do we get clean water? We get clean water from desalination, and that takes energy. How do we get food? We get food. We need energy to create food. Ideally, clean energy to create healthy food, right? We need warmth so that we do not freeze, and we need to prevent, you know, so for weather and survival, it's very critical. So I'm very passionate about those areas. I think China saved the world this winter, and that's what I told a group of bankers in New York last week. You know, is that China saved the world. And I don't know if they intentionally did it or not, but China is the world's largest buyer of oil and gas. And with the lockdowns in China that we saw, they were the first time in 40 years that China lowered their purchases of oil and gas. And this gave the EU the opportunities to buy a lot of this capacity that was in the market. And I think the number Germany spent was close to $500 billion to try to shore that up. Mother Nature also helped save because of the milder winter than what was expected. So there were a lot of things that played into kind of avoiding what could have been in an energy crisis in Europe. We're a global world. You know, I consider myself a global citizen. And so energy crisis in certain parts, it impacts us all in one way or another to some. And then I guess I should say just real quick for full disclosure, I recently worked on a project to take a Fluor Corporation business that we owned a majority stake in public. It's called NuScale Power. It's listed as of last year on the New York Stock Exchange under SMR, but it's a small nuclear reactor, very high tech, carbon-free energy source. And so I'm not a financial advisor. Don't listen to me. I can't predict how well or none of that for full disclaimers. But personally, I think nuclear is going to have to be a part of the mix if we want to achieve energy security moving forward. And nuclear is not the only answer. There are companies that are doing some amazing work on carbon capture, and I think that has to be a part of it. Renewables have to be a part of it. Hydro power has to be a part of it. Hydrogen, there's some really exciting things happening in hydrogen. And I don't know if you caught earlier on in the week, British Petroleum had one of their greatest results, and they have made a commitment to spending $8 billion, and they're gonna chop that between energy transition and also fossil fuels, because we're learning that we need to do energy transition in a very smart, a very calculated, strategic way. We can't just chop certain things out of the mix. We really need it all, and we need to evolve. And China is, really impressive to me because they are taking the lead. They're one of, they're moving faster to cleaner energy than anyone else in the world. And they have over 150 nuclear projects at some stage in the life cycle. And so that's going to be a lot of carbon-free, clean, reliable energy. But again, it's going to take all the players and all the. So it's impacting time to move through. Big time. Yeah, it's impacting the business big time. And treasurers need to be thinking about the China reopening and how that's going to impact the energy market, and how, because that's going to impact us all again, is if China reopens like Singapore did in Europe and the US, which was boom, reopening, then the energy demand could climb. And so that's something I'm paying very close attention to.
No. Yang, how have you been impacted by the energy crisis in particular, and the volatility we've seen in the prices based on all of the technologies and impacts that Todd just laid out?
A very good question. I'm gonna just talk about in practical terms how it impacts my company and what we do in treasury functions. The energy impacted the global, but impacted Europe more so than places like North America and certain places in Asia Pacific. So right now, I'm given my role, I'm sitting in Amsterdam, so I can see that energy bills went up, and then the government come to rescue, and then came down, but it's still at very, very elevated places. So how did it impact the industry or some of the industries where we're playing? Number one, I think everyone is doing the careful calculation in terms of the market demand. And the second one is, can your pricing overpace the inflation? And let me just articulate a little bit more. On the demand side, for example, my industry is consumer packaged goods. Therefore, people's wallet, sometimes when people's wallet get tight, they have to choose between filling the gas or versus when they pay for certain items, right? So we have to be carefully measuring, and certain consumer discretionary getting hit more so than others. But anyhow, need to be carefully observing how consumer behaviors is changing, if it's changing to some extent, or are they trading down, are they cutting back, and how that's going to impact the people's segment, the sectors they're playing in. And number two is the pricing versus inflation, because early on we talk about, everyone's talk about inflation one way or the other. And many sectors, many companies, many brands are trying to somewhat pass on the inflation. Now with the varying degrees of success, right? So therefore, when you have this difficult dilemma when it comes to demand, you have to observe and calculate, and then your pricing versus your cost inflation, that you have a carefully rebalance so that you can protect the profitability. Then what's impacting us from a treasury area? Now, so it's important. I always think that treasury needs to be extremely connected with the business. Is then how does this impact the business performance? Business performance coming to various layers, but very concrete layers, how that impact the EBITDA. Therefore, how much does it impact your net leverage, and how much is impacting your capital allocation, which way you want to preserve your cash if you need to, or which way you want to reinvest your cash so that over the long run you becomes a big winner out of this cycle. So we do a lot of the scenario planning, to be honest. We look at how the business will or will not be performing at to what level. And if we have a capital structure that is still appropriate, we revisited those, still appropriate, and then we communicate a lot. We communicate a lot with our credit providers. We communicate a lot with our rating agencies. We communicate a lot with our credit investors. So I think those things are extremely important. Coming back to the topic of today, right? It's about volatility. I think the volatility will always be there. It's just to varying degree. But what I think is always important is scenario planning. So be able to see and project where the volatility is going to be impacting the business, negative, positive, and do all kinds of different scenarios. So why we know how it's going to be impacting, and then how can Treasury come to really either reshifting our current capital allocation priorities or reaffirming it. I think that's quite important.
No, absolutely. Just to remind the audience, we are taking questions live, so don't keep all your questions to the end. Submit them through the question functionality, and we will hopefully get to those shortly. So if we dig a little deeper into tactical items, I'm sure many of the audience have been impacted by the volatility in currency markets, given the large moves pretty much across the board. I'm interested to know about your hedging policies. How have they held up? Have you made any changes? Have you considered new products or ways of hedging? Yang, coming to you first.
We have about 10 billion plus in the derivatives portfolio. Certain things are just very normal balance sheet hedges and cash flow hedges. Certain things are really out of careful calculation is a math equation in terms of how do we match our debt portfolio towards our earnings and or our cash flow globally, because again, we're present in over 100 countries. So we did a couple of things. Number one, me as a treasurer, always with the philosophy that our job first and foremost is to risk management, to protect the company through cycles. So I'm on the camp not to fundamentally change my hedging practice. And it's a strong philosophy, actually, we're trying to enforce. If a systematic hedging, let's keep doing what we have been doing, because nobody can predict the market. If you can predict the market, I think we'll be wrong anyway. So let's don't try to predict the market. Let's do our systematic hedging. And then once you have the foundation solid, you say my risk management is in its proper place, and let's look at what are on the edges or the windows of opportunity. I always say only windows of opportunity that you can tap into, right? So as an example, sometimes people look at their cash flow hedges to say, well, typically this is a layered hedging policy, but in certain places where the hedge cost is becoming really high, there's a different instrument we can tap into versus traditional forward. Can you do a collar, or can you afford to be on a little bit on the short end versus on the longer end, so on and so forth. So yes, you can play around it, but 80% needs to be still systematic in my view. Then you can play with the remainder 10-15%. The same thing is also true. We also look at our debt portfolio again. Earlier I said we have over 20 billion of debt, and synthetically or organically, we also have debt matching to our earnings overseas. And in those places where recently there's opportunities to monetize, as an example of a certain hedge positions, or there are opportunities for us at least to evaluate those. So then we will sit down to look at that's conform with our risk management philosophy. If it does continue to conform, if there's a certain window of opportunity for us to tap into, then we make a very informed decision. But I cannot emphasize enough the risk management angle, because again, we're here to first and foremost to protect the company and then to create value for the company.
No, absolutely. Todd, even if the products or policy hasn't changed, I'm interested to know how the scrutiny from the board or risk committees have developed over the period of volatility that we've seen over the last few months and years.
Yeah, I've always been a big proponent of the hedging policy and procedures being very open, giving treasurers the ability to be very nimble and to react to market conditions that are evolving and changing very quickly. And I can remember 4 or 5 years ago, it seemed like the trend was, a lot of treasurers I spoke with was, we want a hedging policy that is it's so tight, and it's so, if this happens, then you do this, if then. And they felt like they were putting good controls on their hedging policies to prevent, any deviations from that. And so I think the intentions were good, but it was completely counterintuitive, I believe, to the role of a strategic treasurer, which is to make smart decisions, but you have to have the flexibility to make those smart decisions and to react to certain market conditions. And I think investment policies, we should see the same thing there, because just like one of the things is money fund reform. So I had a discussion a few weeks ago with a group, and it was all about, I think they did a webinar. It was all on money fund reform, and it's very interesting. And there's certain things that are going to impact treasurers and how we invest, and we could see some, just like with the previous round of money fund reform and the gate provisions, which they're now thinking of removing those. But those gate provisions were designed to be to have the investor feel safer, right? But what they ended up doing is, we're natural, we're all humans. They started to see, okay, well, they're starting to trigger some of these or get near to, and then it caused what we call contagion, right? And if you get a chance, there was a chairwoman who wrote a paper at the time of that money fund reform coming out, 2014, but I think effective 2016. But she warned of this potential impact from these gate reforms. And she wrote a letter. You can see it on the SEC website. And she didn't just warn in one paragraph. It was 6 paragraphs where she clearly outlined what could happen. And they went ahead and did it. And exactly, 4 to 6 years later, the pandemic comes, and she was exactly right on. So it's one of those things where, with this new money fund, there's good intentions, but what will happen, and will it swing more out of prime and into government treasury type instruments, municipal? So I think those are ways that may kind of impact how we think about investing, and those policies just need to be. So I think it's a good time right now, especially giving all the spotlight on treasury with what we're seeing in the markets. It's always when we see FX volatility, commodities, now inflation, interest rates, right? Just because we run capital markets and we run risk management. And so now we're under the spotlight. Now is a good time, I think, to re-engage with the board of directors and the ELT and your treasury teams, and just kind of reassess where are we with these policies, and do we want to classify cash, operating cash liquidity? Do we want to think about them a little different? Hopefully we can avoid the dash for cash impacts that we all saw during early 2020, mid 2020, throughout 2020. But yeah, so we've learned a lot.
Just on that point,
yeah.
Is it worth just going into a bit of detail and talking about the impacts we've seen on credit lines and cost of hedging? Obviously, markets have gone crazy, and that impacts pretty much across the board. So how have you seen that kind of widening of credit spreads impacting kind of your financing needs and your FX and other hedging needs as well? Yang, shall we go to you first?
Excellent question. As a matter of fact, I was just talking to some closer banking partners in terms of the impact to them, first and foremost, right? I'm of the camp where we manage bank relationships strategically, because there's a through cycle, this moment that you need their support, and certain times that they will potentially need your support as well. It's going to be, if it's going to be a mutually beneficial relationship, you need to allocate your wallet wisely, and you need to understand their constraints, and so on and so forth. So in terms of liquidity access, it's getting tougher, definitely, and there's things to still being done. Of course, it's a higher rate, but from a banking perspective, I think it's particularly in the U.S., there's some more heightened or discerning choice of credits, how they deployed cash. Therefore, in terms of, let's say, liquidity revolver, at the backbone of liquidity, we or many companies took advantage and redid their revolver so that they still have multiple years to come along, so on and so forth. But at this given particular moment, I think it will be more difficult than what it was maybe a year ago. This is number one. And number two, I think in terms of access to liquidity, we always have a catalog of how we go. For example, you have your revolver already, as I mentioned, right? And hopefully that can sustain through cycles whenever that you need. But then be able to foster an understanding of is there any other credit that you can tap into? I mean, working capital wise, there are certain ways you can tap into liquidity or on company line, or you have a longer or shorter revolver, depends on how you need it. And if there's any other things you can tap into that either through some higher credit markets and issuers can get into commercial paper, so on and so forth. So I think it's always very good to have a menu of the liquidity pockets that we can get into. Now, of course, at a certain point in time, the rates will be different, the access, the depth of access will be different. But having those always in our disposal, and because of the reason that you need to secure them through cycles and allocate or foster your relationship wisely and allocate your wallet wisely through cycles, and to make sure that those liquidity pockets doesn't dry up when you need them, is something quite interesting. And ultimately, why this is important is it also drives the company's capital allocation decisions, where you need to be in terms of your credit rating and credit profile. So people would, even in a discerning market, people would like to deploy, capital towards you, and those kind of things are all linked together. A long way to answer the question.
So we're definitely just starting to see two major corporate capital transition themes. Debt-funded acquisitive companies seem to be pausing, and the level of share buyback seems to have reduced, both moving towards favouring debt repayment. If you add that to large moves across all asset classes, naturally comes extremes in mark-to-markets, which may also have to be funded or might be a surplus of cash related to them. Has that focused your mind on access to capital and working capital optimization? And how are you thinking about that, Todd?
Yeah, I would say share buybacks, right? They're gonna tax share buybacks, so no one's gonna do share buybacks anymore. That's being very it's a joke, dry sense of humor. Yeah, but no, I think to your question of credit lines, right? And we all know that our bank, I think it's an area that treasurers should be focused on right now, and it goes along with what we talked about earlier, being a very focused leader as a treasurer with excellence, humility, and confidence. And so, speaking to the banks, building that relationships, each of the banks, right? They view banks are like human beings. Every one of them are different. Every one of them have strengths in certain areas, and everyone has areas where they don't spend their time focused on being the best at that specific area. So, so like Yang said, it's about finding the win-wins in your bank group with your banking partners and external partners, whether they be supply chain finance partners or partners you're working with on one-off deals for securitizations to monetize some AR maybe. But the credit line for hedging, all the banks have their own models on how they determine how much credit lines they want to give us. Well, and we've all, the CVA, the DVA, the XVA, some of the banks have their own acronyms for how they determine, and it's kind of like, the basic ways that we look at on what is the potential mark-to-market, what could the magnitude of that mark-to-market be, and that's basically what the banks want to determine. So it's a great question, Lisa, because as we continue to see this volatility across asset classes, the banks the credit committees ultimately of the banks are they're definitely reassessing, okay, what we may have been able to do from a notional in a certain currency pair, or swaps, in the interest rate space, or commodities. We may need to kind of lower that in, because we don't want to necessarily. And then a lot comes down to, do you have a credit support annex agreement in place, and those certain things. I recently wrote an article, and I used the Japanese insurance companies, the pension funds, those long-term investors that have long-term liabilities. And for a long time, one of the things they did amongst other strategies was buy U.S. treasuries, and then they would hedge the FX risk on a short-term rolling basis. So, and it was very profitable for them. And U.S. treasuries are still deemed at this point as the most pristine collateral that you can get in the market. So that's something that worked for 20, 30 years in this environment that we had, but economics are changing. And so even they are having to reconsider, because that trade is no longer, in some cases, it's no longer profitable. So are they going to lower treasury holdings and use other products to be able to meet those liabilities, those longer term liabilities? So
let me just jump in there, Todd. We've almost come to the end of the session. I wanted to give both of you a chance to share a final thought or recommendation to the treasurers on the call, based on your experiences. So I don't get into trouble with Mario. Perhaps if we can keep it to Maria, a quick 1-2 minutes each. And perhaps let's come to you first.
Love to. I love my treasury job. I wear multiple hats, but I really I stumbled into treasury, but I really love this job, because I think it's a window of opportunity to internal business, but also external market. That's why it's intellectually stimulating. But one thing I came across an article I really think is right is to say many companies, they strategically manage P&L. You hear people often talk about the EPS and projections and so on and so forth. Top tier companies, they manage strategically both the P&L and balance sheet. And I think being the treasury professional, is our duty to be able to reinforce a message that strategic balance sheet management is really paramount, and is paramount through cycles. During volatility is heightened years, even more so, but through cycle is really our duty. So please let us to take the strategic balance sheet management extremely seriously. Be wary about liquidity, be wary about risk management all the time.
Perfect. I can definitely agree with you there, Yang. Todd, we have 1 minute left. Have you got anything to share recommendation-wise?
Yeah, I guess I will steal some other treasurers. But one story, the treasurer of Prudential Financial, she mentioned, and I believe it was certain instruments. I like to listen to the cello. I like to hear a violin. I like to hear a trumpet. But when you put them all together in an orchestra, it creates magic. And humans and the magic of an orchestra. And that's something that just stuck with me. And so I think that's important for treasurers to think about and keep top of mind. And then the last thing, just real quick, former treasurer friend of mine, George Zen, at Microsoft for 25 years, now retired, make sure that the culture, because they're looking to the treasurers to really support and build that culture. And so don't be the know-it-all culture. Make sure it's the learn-it-all culture. And that comes from good leadership and the humility part of being a great leader.
Perfect. I'd like to thank both Yang and Todd for sharing their experiences, and to you for all of your time. And I'll now hand back to Mario to conclude the webinar. Thank you.
Thank you, Lisa. Before we go, I would like to say a few thanks and give you some information on the upcoming activities. So please let me first thank Lisa for chairing this session and Yang and Todd for sharing their experience and best practice. I would also like to thank Deutsche Bank for making this event possible. And finally, thank you all for being here. I hope you found the session helpful. Through the platform I mentioned before, the Global Treasury Leaders community, you can exchange experiences and ask questions to all the members, and we share content on a regular basis. So please feel free to continue this conversation with the speakers and colleagues there. You can join using the link I shared with you earlier on the chat. The next webinar will be on digital marketplaces and the role that treasuries play enabling growth, security, and efficiency in those new platforms. So again, very topical. Please watch out for our emails. We'll be sharing more information shortly. With that, I'll let you continue with your day. I just want to thank you again and hope to see you again soon. Thank you.
Thank you.
Thank you.
Have a blessed day.